Inflation is one of the quietest thieves in retirement. It doesn't usually show up all at once with sirens and flashing lights. It just keeps taking a little bit more at the grocery store, a little bit more at the pharmacy, a little bit more from your travel budget, and eventually a whole lot more from your lifestyle than you ever expected. One of the most dangerous assumptions any retiree can make is this: don't worry, inflation is probably just transitory. Heck, it's what many politicians and pundits from both sides of the aisle have told us for years. Maybe it's true, but history says you should be careful with that word transitory. Today in the Retirement Income Lab, we're going to talk about what inflation really does to a retirement plan, why it often lasts longer than people hope, and what high saving professionals can do to defend their purchasing power without taking foolish risks. I'm Patrick Huey, certified financial planning practitioner. Let's get to work in the lab.
You're entering the Retirement Income Lab with certified financial planning practitioner Patrick Huey, where your questions about retiring and staying retired get answered. No hype, no stock tips, just data, discipline, and the right decisions to help you make retirement a reality. You ready? Good. Let's get to work in the lab. Here's your host, Patrick Huey.
Well, welcome back to the Retirement Income Lab, where high saving professionals turn portfolios into paychecks they can actually live on. If you're within about 5 years of retirement or just into it, this series is for you. We stress test real retirement income decisions so you don't have to test them out there in the real world with your own life savings. Now, if you watch this and think, hey, this sounds like us, you can schedule a retirement income lab assessment with me at victoryindependentplanning.com/contact. For now, let's dig in deep on inflation. Now, inflation matters at every age, but it matters differently, much differently in retirement. When you're working, you still have a human capital engine. You're still generating income. And typically that income will go up over time. You may get raises. If you don't, you can work longer. You can earn more. You can even cut back on discretionary items if you have to. In retirement, that cushion is smaller. Now your portfolio, Social Security, and any other income sources, they have to carry the full load. So when inflation rises, it's not just an annoyance. It puts direct pressure on the paycheck your assets are supposed to provide you each and every month. If your retirement income plan is static, while your cost of living is not, guess what? Math eventually stops being your friend. And that is especially true when people underestimate how powerful even normal inflation can be over time. So let's use some simple numbers. At 3% inflation, your cost of living roughly doubles every 24 years. At 4% inflation, it doubles in about 18 years. Now, that means if your household needs $120,000 a year today, a long retirement could require something over $240,000 a year just to maintain the same standard of living. Not a better one, the same one. And if you think that sounds extreme, ask yourself what groceries, insurance, housing, cars, and healthcare cost compared with 20 years ago. And if it still sounds extreme, check the most recent Consumer Price Index report And you'll see, at least as this recording, that that change year over year was over 4%. Retirement's not just about having enough money to stop working. It's about having enough purchasing power to stay stopped. Now, let's talk a little bit about this comforting story people love to tell themselves during spikes in inflation. It's transitory. It's temporary. It's not going to last forever. Sometimes that's right. Sometimes it is transitory. But we took a look at a research report. It's titled History Lessons: How Transitory is Inflation. Now, you know I love anything with the title History Lessons because that's the title of my book that I published in 2018. But this particular report, which is not related to that book, makes a very important point. Looking at inflation across 14 developed economies since 1970, the authors found that moderate inflation often does fade. For instance, when inflation first rises above 4%, more than 60% of the time it never goes above 6% before starting to fall back down. The bad news is that once inflation gets above 6%, those odds shift dramatically. And once inflation exceeds 8%, it continued rising more than 70% of the time. Now, that should get your attention, not because of what's going on today, but what happened back in 2022 and 2023 when the inflation genie got out of the bottle and exceeded 8%. In other words, mild inflation spikes will often calm down. But once inflation becomes more entrenched, I would claim, like it did earlier in this decade, history suggests it tends to stick around a lot longer than policymakers, investors, and cable news optimists would prefer. And here's the part retirees really need to hear. Getting inflation back under control often takes years, not months. The research found a median time to get inflation back below 3% of roughly 1 to 2 years when inflation starts around 4%, about 7 years when inflation crests over 6%, and from 8% or higher, you're looking at 6 to 20 years with a median above 10 years for that inflation to get back down below 3%. 10 years, in my mind, is not transitory. It certainly isn't when it comes to retirement planning terminology. So, what do we have here? This is a planning condition. This is a condition that needs to be instituted and incorporated into your financial plan. Hope is not a strategy. Let me give you a real world example of why this matters. Now, I recently did a second opinion for someone who came in with a financial plan from another advisor. Nice charts, clean binder, fancy software, everything looking very official and pleasing to the eye. But when I started digging into the assumptions, the inflation rate in the planning software was 2%, as if that was going to happen any minute now and stay there. Now, is that the advisor's fault? Not really, because 2% is often the default setting in much of the financial planning software out there. It was realistic a decade or so ago when a lot of this started to roll off the shelves. But it doesn't work anymore. Now, when I saw that 2% in her plan, I thought, based on what? Where did that 2% come from? Because, like we just said, hope is not an inflation assumption. If you build a retirement plan on the idea that inflation is going to neatly settle down to 2% very quickly, you can make almost any projection look a heck of a lot prettier than it really is. The probability of success goes up. The future spending needs look smaller. The withdrawals appear more manageable, but only because the assumptions are doing the heavy lifting, not the facts. Now, folks, that's a big problem because when a retiree sees a glossy plan that says everything is fine, they may not realize that the plan is only fine if inflation behaves exactly the way the software designer or the advisor wanted it to. In the proprietary second opinion meetings that I have with folks, one of the most useful things we can do is not merely ask, what does the plan say? It's to ask what had to be assumed for the plan to say that. Let me say that again. It's not what does the plan say, it's what had to be assumed for the plan to say that. If your retirement plan still quietly assumes a quick return to 2% inflation as the default, without any real stress testing around higher numbers, you don't have a plan. You have a wish. So why does inflation persist? Well, part of the reason is because once it gets into the system, it tends to feed on itself. The research we cited says that workers ask for higher wages, businesses raise prices to cover those wages, and consumers start expecting higher prices and change their behavior. Inflation expectations become embedded. That makes it much harder to unwind. And that research points to the Volcker era in the early 80s for a reason. If you remember the early 80s, it took extraordinarily high interest rates to break entrenched inflation. And even then, it took about 2 years for inflation to get cut in half and more than 6 years to get back to something like 2%. And Volcker wasn't messing around. He was raising interest rates to like 20%. And it still took 2 years to get inflation to halve. So when someone tells you, I'm sure inflation will be back to normal soon, the right response is not panic, but it also shouldn't be blind faith. It should be, well, maybe it will, but my retirement plan had better still work if it takes longer. Now, inflation tends to expose weak retirement strategies. Let me give you 3 common mistakes. One would be hiding in cash. Yeah, cash feels safe because the balance doesn't bounce around very much. But if inflation runs at 3 or 4% or higher and your cash earns less than that after taxes, your purchasing power is going backward each and every year, quietly, politely, but relentlessly. Second is relying too heavily on fixed income that doesn't give you enough growth. Now, a bond ladder or a fixed annuity may have a role in your plan. But if too much of your income is fixed while your costs keep rising, you may be locking in a standard of living that gets worse over time. Then third is using a rigid withdrawal strategy. If you insist on pulling the same amount from a portfolio, no matter what inflation and markets are doing, you put more pressure on the portfolio during exactly the wrong periods. being a little bit more flexible can help alleviate some of the effects of both inflation and poor markets. So inflation is not just a line item, it's a stress multiplier. Now, this is why retirees usually, I'm going to stress usually, still need some stock exposure. Not because stocks are fun and not because volatility is somehow good for your soul, but because owning productive businesses has historically been one of the better ways to keep up with inflation over long periods of time. If your retirement might last 25 or 30 years, you need at least part of your portfolio growing faster than the cost of living. Now, that said, and this is important, inflation is not just an argument for being reckless. Too much stock exposure at the wrong time creates different problems, especially if you retire into a bad market and you're simultaneously dealing with high inflation and large withdrawals. In that case, you just might get hit from both sides. That's why the answer is not forget inflation, go 100% conservative. But the answer also is not inflation is scary, therefore go 100% aggressive. The answer, as it usually is balance. Enough growth to defend purchasing power and enough stability that a bad sequence of returns doesn't wreck the plan. Now, let's use a simple example. Let's say a couple retires at 65 with $2 million invested and needs $80,000 from the portfolio in year one, on top of Social Security. That's a 4% starting withdrawal rate. Now assume inflation averages 3%. If they blindly increase that $80,000 with inflation every year, that withdrawal becomes about $92,700 in 5 years, or about $107,500 in 10 years, and roughly $145,000 in 20 years. Same purchasing amount, much larger dollar amount. Now, imagine they tried to avoid all market risk by moving almost everything into cash and short-term instruments, earning, say, 2% after fees and taxes. Their spending need is rising at 3%. Their assets are compounding at 2%. That's not a recipe for confidence. That's a recipe for what we would call a slow squeeze. On the other hand, if they stay too aggressive and retire into a sharp bear market, inflation-adjusted withdrawals can magnify the pressure on that portfolio. So again, this is why retirement income planning is a design problem, not a slogan. So what should retirees actually do? Here's a few practical things. First, build inflation into the plan from the start. Don't use today's spending and assume it will stay there forever. Create realistic scenarios for your spending and how it's going to increase due to inflation. Second, separate essential spending from discretionary spending. If you know what must be covered and what can flex, you gain options. Third, maintain some stock exposure for long-term growth. How much depends on your risk preference, your risk capacity, and the actual job that your money needs to do. Fourth, keep some reserves or stabilizers, cash, short-term bonds, high-quality fixed income, maybe guaranteed income in the right case. The point is not maximum return, it's durability. Fifth, pay attention to taxes. If inflation pushes up nominal withdrawals from traditional retirement accounts, meaning tax brackets don't adjust while inflation is rising, the IRS may quietly become an even more enthusiastic partner in your retirement plan. Sixth, and finally, revisit your plan. Inflation assumptions, spending habits, portfolio structure, and withdrawal strategies all need occasional tuning. If you're still sitting in a plan that's built around 2% inflation, you definitely need an update. Retirement is not a crock pot. It's not a slow cooker. You don't just turn it on, set it, and forget it. So what have we learned? First, inflation's not just annoying. It's one of the central risks to your retirement. Second, even moderate inflation can do major damage over a long retirement because it compounds. Third, history suggests that once inflation gets high enough, it often lasts a lot longer than people think or they hope. Fourth, retirees usually still need some growth exposure to protect their purchasing power. And fifth, too much risk at the wrong time can be just as dangerous as too little growth. The goal is not to predict inflation or anything else perfectly. The goal is to build a plan that can survive it. Now, if you're watching this and thinking, we have a retirement plan, but I'm not really sure we built inflation into it, that's exactly the kind of thing we work on in the Retirement Income Lab assessment. I'm a fiduciary, certified financial planning practitioner, and I'm the owner of Victory Independent Planning. And I work with high-saving professionals all across the country who are within about 5 years of retirement or recently retired. And in your lab assessment, we can stress test your income plan against different inflation assumptions. We can look at whether your portfolio has enough growth to defend purchasing power. We can identify where rigid spending or tax drag could create future problems. And we can help you build a retirement paycheck system that can adapt when real life refuses to cooperate. So if you'd like a second opinion, go to victoryindependentplanning.com/contact and schedule a short call. And hey, if you found this helpful, please subscribe to the Retirement Income Lab, hit the like button. It's going to help more people find these conversations. In our next episode, we're back to talking taxes because I've got 5 tax strategies that your advisor isn't talking about. It could save you a lot of money. Thanks for watching, and I'll see you next time in the lab.
This has been the Retirement Income Lab with certified financial planning practitioner Patrick Huey. To stress test your own retirement income plan, visit victoryindependentplanning.com/contact and schedule your introductory call today.